One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. My name is Alex Mason and I am your host. Now, the purpose of this show is to help you prepare for investment banking by understanding both the technical and non-technical aspects. And we're exploring a lot of different concepts here on the show. Right now, we're talking about the connections between the financial statements. And we just talked about what happens when a business makes a sale. And now we're going to be talking about paying expenses. What are the things that happen when a business pays its expenses? So the reality is there's a lot of different expenses and they're all shown on the income statement. They could be things like research or development. They could be general or administrative expenses or sales and marketing. And remember, these are major broad categories. Now, those numbers go up as expenses on the income statement. So that's the first thing that you're going to see. If you have more expenses, you're going to see that reflected there. And remember, we're only counting expenses for the exact time period that's covered in the income statement, not necessarily expenses covered in other time periods. An important caveat there. Okay, so we have expenses on the income statement. Now, when that occurs, we're going to have accounts payable on the balance sheet increase. Remember, the balance sheet tells us what the company owns and what the company owes. And accounts payable, that represents the money that we're going to have to pay to a supplier or a vendor. And so that's a liability on the balance sheet. So that's going to increase. And this makes sense because now the company needs to actually pay for all those expenses it is incurring. And remember, in accrual accounting, there's this lag, a time lag between being billed something and actually paying for it, just like it happens if you use a credit card. So that's what happens on the income statement and the balance sheet. And then let's look a little bit at what happens here with the income statement as well. Now, just like an increase in sales increases net income and retained earnings, an increase in expenses decreases net income and retained earnings. Remember, there's this connection between the profit or loss a business makes on its income statement and the equity that we see on the balance sheet. It's just like if you're running your own, I keep using this example, but it's, I think, a great example. It's timeless. The example of the lemonade stand. If you have a lemonade stand and you pocket $3 in profit, and then you go on to the next year and you pocket another $3 in profit, if you make that amount of profit, then you have $6 of extra equity in your business because you own more things now. You've generated a profit. And so that's why we had this connection between net income and retained earnings. So that's something that happens. Now, when it comes to paying our bills, we have to actually pay the bills for the company. On the balance sheets, cash is going to decrease, right? Because that's an asset that we're giving up now in order to settle our accounts. So that goes down on the balance sheet in the asset section. And so does accounts payable by the same amount. Remember, accounts payable is on the liability side of the balance sheet. And so we're essentially trading cash for lowering our accounts payable. And so that means that our balance sheet now balances because we have the same amount of money changing in the same direction on both sides of the balance sheet. Now, at the same time, let's look at the cash flow statement here. Remember, we're using cash. Cash is an asset, but it's also flowing through the cash flow statement. So our cash disbursements increases on the cash flow statement because cash has now left the company. So when I say cash disbursements increases, I mean like a negative number flowing out. So our cash outflows have increased. So that's how we connect these three things when a company pays a bill. Just to recap, on the income statement, you're going to see that expense there. It may be a certain type of expense depending on how it's going to be classified. So that is reflected there. And then your accounts payable on your balance sheet on the liability side increases because now you owe money. You owe your vendor a bill, just like a credit card. And then your net income is going to decrease because of an increase in your expenses. Remember, profit is a function of revenue minus expenses. So if expenses goes up and your revenue is the same, well, then your profit is going to go down. And when your profit goes down, your retained earnings also go down on your balance sheets. And then you actually pay the bill. Cash decreases on the balance sheets. That's an asset that goes down. Likewise, accounts payable goes down. Your balance sheet is balanced. And then moving over to the cash flow statement, you have an increase in cash outflows because you've actually paid someone and cash has left the company. So that's what happened. And I'm going to be talking next time about borrowing money and selling stock. And that's another suite of connections between the three financial statements here on Investment Banking Insights. My name is Alex Mason, and I'm your host.